30 years of finding brands that capture $1 billion.
The analysis of the Indian economy has been a fast-changing one this year. If 2 months ago we were worried about the currency and inflation, today we are fretting about growth in the fiscal deficit. But it's not just the economic data that has kept economy watchers busy, it's also economic controversies. Is the back data on the new GDP series believable? Is the government trying to raid the RBI's balance sheet? We are hoping to get views on all of that and more from Rajeev Malik, strategist at River Valley Asset Management and a long-time Indian economy watcher. Rajeev, let me first thank you for joining us on BloomberQuint. Lovely to have you here.
My pleasure, Ira. Glad to be here.
Rajeev, I'm going to start with what's top of mind, although some of the more interesting topics that will come later. The GDP data we got on Friday was a bit of it wasn't entirely a surprise. We were expecting a lower print, but I think the extent of downside compared to Q1 was a little bit of a worry. What was your own analysis of it? Most people picked on the slowing growth in consumption as the thing to note.
I think that's a fair assessment, although the caveat remains that expenditure GDP accounts for India need to be taken with a bag of salt. The GVA numbers tend to be more reliable, but even they showed moderation. Quite frankly, the first fiscal quarter's 8.2% was an exaggerated number, and anybody who was celebrating that kind of momentum was obviously way too early and premature on that. My sense remains second half of the fiscal year will be a touch below 7. So anyone who's got a GDP full FY forecast of around 7.4% or so will have to shave down the numbers marginally. I think the bigger issue here, once again, is a lot of the hyped up expectations about growth picking up, accelerating, etc., have generally been disappointed, apart from this quarter-to-quarter volatility that's been there in the works.
Rajeev, I'll get to the debate over the new GDP series in a little bit, but if one takes that at face value, it does look like, say, 7 to 7.5% growth in the Indian economy is par for course. It's not something that one should scoff at and say that we are growing well below potential, because potential seems to be closer to 7, if not a little bit below that.
Once again, a fair assessment. One will just have to dig into a lot of the details to try and figure out how just revising GDP numbers is changing the underlying potential GDP. And again, don't forget, potential GDP are always estimates depending on the kind of technique used. But these are pretty large swing factors. I think it's somewhat comical in a way, almost distressingly comical, if I might add, that while we are trying to evolve into a brighter future, there doesn't seem to be any consensus on what the past GDP record has been.
Well, absolutely, and I will come back to that issue in a minute. But if one looks at, say, the growth scenario, as we know for Q1 and Q2, everyone expecting that Q3 will see some impact of the financing strains in the NBFC sector, even if that, balances out by Q4. So growth is, perhaps a little bit soft. Inflation has underperformed the expectations, which leaves us with, policy rates which should stay steady.
For the next several months, yes. I mean, I think given global developments, including with what's happened to crude oil, and it's literally a sea change compared to the last time around in October when RBI actually stayed on hold but shifted its stance towards moderate or incremental, calibrated tightening is the expression they had used, although I still don't understand what that means. Very few central banks actually define tightening in that manner. But I think there's a strong case for the MPC to actually shift stance back to neutral. I would be surprised if they do it this week, simply because central banks or MPC don't want to swing about those magnitude of changes. But come February, there's a pretty strong chance that they will shift to a neutral stance once again. Don't forget, staying on hold this week is still very much consistent with the initial guidance that the MPC has given, because basically it means they stay on hold or they raise rates. Raising rates in the current environment seems to be a pretty low probability, unless once again we see a massive reversal in the kind of favorable news flow we've seen recently.
Rajeev, where have they gone wrong? Have they gone wrong in their understanding of inflation, or is it just the headline number being thrown about by the food price scenario, which then leaves them to have to dissect it into core inflation, what is real inflation and what is just headline inflation movements?
So there are a couple of factors, Ira. First off, I think the only way one can get a forecast right consistently all the time is by not making one. I think all analysts will realize that they've got stuff wrong or off from time to time. Analysts don't necessarily face the heat as much as central banks do. The second point really is, I think the most puzzling aspect has been the well below trend food inflation. Now, it's easy for the government and many others to crow about that, look, this is a sustained downshift that has taken place. I'm not totally convinced. I mean, you can't have this level of food inflation given the distress in the agriculture sector, in the farm sector. So unless we think that's going to be the new normal, we really can't take the food inflation numbers at face value. If you believe that, plus if you put in context that core inflation actually has been exceptionally high, and even if we see some rolling over given what's happened to the commodity complex, it is still pretty high. So, if you're a policymaker, the fear you would have, and you're looking beyond just a few months, is that if there is once again unexpected jump as far as food inflation is concerned, what does that do to meeting the target on a sustained basis? I'm not talking about next few months, but really from a longer term perspective. And I think that is where some additional clarity from the MPC or members about how they think about food inflation would actually be rather useful.
And also, I think Ravindra Dholakia, for instance, has raised the question as to whether the dynamics of inflation in India have changed, whether the inflation targeting framework has already had some bearing. He'd written in the EPW about this. The central bank probably needs to study inflation a little bit more.
I think that's a fair point. There are always different variations. If you recall, at a much earlier time, the whole issue about protein-driven inflation was something that had actually been pointed out by RBI'S research, and that's when the markets and analysts also jumped on it. So I think we need some more clarity, some more digging in deeper, etc. I should point out, this talk about inflation dynamics having changed, bear in mind, I mean, just a few months ago, everyone was worried about inflation picking up. And in fact, RBI, MPC actually tightened twice consecutively. So I think there are many flip-flops that are happening globally. Oil prices are a very good case in point. But equally, I think part of the soft patch on inflation that we are seeing is also a function of growth not having picked up as quickly or by as much as people were anticipating or wishing for. So the real test of is there a new normal for inflation, new lasting normal for inflation, will really be if the economy is chugging along quite well and the MPC is able to manage inflation within its target range. We are not there yet, and we may not be there for some time. So that would really be the real test of whether or not inflation dynamics have changed.
Would you expect,
for the better and on a sustained basis.
Would you then still give some probability to the rate hike cycle restarting next year?
Pretty low at this point. I think what we've witnessed in terms of oil complex, rupee rally, generally all pro or favorable to EMs in general, I think lessens the probability. The only scenario that I can see is either core inflation rises further, which is difficult to see unless we begin to see sharply higher pickup in demand dynamics, or food inflation actually reverses quite aggressively. These are, or rather the latter reason is perhaps the main one why the MPC is not going to jump the gun and shift its stance again. But February meeting is going to be quite crucial. They will have far more information that then gives them some leeway which way they want to swing.
Rajeev, apart from the critique that they have raised rates a little too quickly and hence the real rate is too high, which we've sort of discussed, the other critique is on the liquidity management at the RBI, particularly since these NBFC strains have started. People think that the RBI has been just too conservative on the liquidity front. Do you think there's some reason for that criticism and it's justified?
These situations, the criticism against RBI always gets exaggerated. So the first line of difficulty, and everyone wants a CRR cut. I mean, there's a fundamental shift in how RBI thinks about CRR, which is part of the reason why, in an aggressive, lasting manner, it has not been used for quite some time. And quite frankly, the central bank is injecting liquidity via the two other means that it has. OMOs and intervention in the currency market. Now I think dollar rupee has pretty much had its good run. RBI will try and manage it around the 69.70 mark, and any kind of flows that try and push it to strengthen further, there would be good reason for RBI to mop those up. So everyone wants a quick, instant fix. That is not possible. More important, perhaps, would be a structural reassessment in how to think about the NBFCs as such, especially from a macroprudential standpoint. What was missing, or what got hit massively, was the whole trust factor, the confidence factor. And that is where some of the structural reforms or regulatory reforms, etc., need to change, and that will take time.
No, 100%. But just to sort of close the loop on this, on the RBI conversation, one should expect the NBFC situation to have a bearing on growth in the next couple of quarters, because it's, while the banks may step up their lending, cover up some of the gap, there was some data from the industry association suggesting that in October there was a 15% contraction in NBFC credit going out. That will have an impact on growth.
Most definitely. I think some of the high purchase numbers that we see for vehicles, etc., are already indicating some of that stress. But I think you have to put in a much more broader framework. That is it going to be longer lasting, or we're really talking about a couple of quarters before some of that stress actually begins to improve. Don't forget, a month ago, everyone was literally talking about that the whole sector is going down the toilet. And then slowly, the liquidity situation began to improve, etc., as well.
All right, Rajeev, let me just shift focus from economic data to economic controversies. I think we were joking that this is the first time that the MPC meet will get less attention than the RBI Central Board meet, which is just a few days after the former. What have you made of this, tension between the RBI and the government? And I think everyone is now focused on what happens to that committee, which is going to look at the central bank's balance sheet.
See, it's the most unfortunate outcome. I think if anybody were ever to write a book on central banking or communication between central banks and governments, there would be a chapter on how not to do things. And this particular episode will clearly feature, or should feature, there. It's important to realize the boundaries. RBI has to be accountable. It is not a legally independent central bank. The MPC component is one part of what all responsibility it has. Equally, the government needs to be mindful that the central bank is not a vacuum cleaner to clean up whatever mess is made elsewhere. Neither is it operated via remote control. So I think this has been a classic case, and maybe lack of experience, perhaps, or adequate experience in engaging with bureaucrats could have resulted in a bit of a exaggerated reaction, but highly avoidable altogether. Don't forget, after all the hue and cry, ultimately the government did land up getting most of the stuff that it was looking for. Quite frankly, on a relevant topic in terms of capital structure as far as RBI is concerned, the right approach was always to set up a panel, set up a committee to look into the various dimensions, which is eventually what has been announced. Now we'll see who are the members and what the recommendations are. But I think RBI needs to understand it can express an opinion, it can disapprove the government's point of view, but in the end, the sovereign essentially calls the shots in India. What is required from the sovereign's perspective, from the government's perspective, is not to do anything reckless in a very politically self-serving manner. Bottom line, both of them need to avoid a repeat of Israel's position, where its central bank landed up in negative equity. I think it was in 1999, after some of the exchange rate related translation gains were given out to the government, which was part of their whole accounting methodology.
Rajeev, do you think, I'm not going to go into the technicalities of the balance sheet because, for one, I don't understand them well enough to argue them out with you. But, just in terms of the way this whole thing played out, do you think the RBI came out a little bit poorer in the sense that everyone now has a belief that it's the central board of the RBI which is calling the shots, which then leads to a number of subsequent questions. Who is on the central board? What are their leanings? And then also, what is the role of the governor if the MPC is deciding on policy and the central board is deciding on banking regulation?
That's true, and we get into what is legal, what is best practice, what should be adopted, etc. But bear in mind, every institution in a way is as good as bad, as good or bad, depending on the people working there, and the leadership always has to be on the forefront. I think this is the first time in a very, very, very long time that we find a fair amount of silence as far as the governor is concerned, even on issues of topical economic interest for everyone in India. I can't recall the last time this happened, which is part of the reason why you always found some governors running into rough weather, right? I mean, that was true for Dr. Reddy, that was true for Dr. Subbarao, it was true for Raghuram Rajan, but all of them were vocal, right? We knew exactly where they stand. I think communication-wise, RBI has actually worsened quite substantially, I would assess. It is interesting, even the post-policy conference call with analysts, etc., the minutes are not put up on the website. The call really doesn't take place as aggressively as it used to. So there's a lot that can be said for communication improvement here. Just having an item number every 2 months is just not enough. People would love to hear a different point of view, more point of view, without just that communication getting way too excessive.
Even with the markets, right, Rajeev, I think you constantly hear the complaint that there is far lesser interaction with the markets or with the bankers than there has been in the past. Is that the right approach? I mean, in some ways the central bank is saying, look, we don't want to absorb everything the market is doing.
I think there is merit in not necessarily reacting to every little pressure point, every comment that's actually made, or every request or desire that is put out by market participants. But you have to bear in mind, I mean, it's not as if the financial system in India is very, very well developed and everyone will figure out eventually what's going on. The best example I can give you is the MAS in Singapore, which almost never comments on anything. But then it doesn't run into, I mean, it's a very credible central bank. It doesn't run into any unnecessary controversies either. So there is something to be learned. And while I'm a big fan of effective communication, and that automatically means saying more but talking less, as opposed to talking more but saying less. And I think that is something RBI should really think about.
All right. Rajeev, let me move to the other controversy which has emerged, and that's about the data, the economic data, GDP data. What did you think, or very simply, what did you think of the back data on the new series?
See, once again, I think GDP is an estimate in every country, and every country will have some loopholes, some qualifiers, some assumptions that are put in. To me, I think the biggest issue, far more than the quantum of revisions that have taken place, because one can dig into the details and see whether or not that is consistent, although I have to confess, at face value, some of them don't necessarily sync with the kind of momentum we were seeing in other indicators during the past phase. Credit numbers are a very good case in point. Inflation numbers are a very good case in point. And all these revisions will raise questions about, what is the inflation growth trade-off? Do we have to throw out all the initial models that one were necessarily assessing them on? What is potential growth? What are the reliable drivers driving this growth, etc.? But to me, this controversy perhaps would not have been as severe as it has been if Niti Aayog had not been involved in that press conference. Quite frankly, it has no business to have been there, even if behind the scenes there was a lot of technical chat or communication, etc. The optics of Niti Aayog and the CSO chief statistician presenting it together just don't look good.
In both of these, Rajeev, I mean, whether it's some of the issues that have cropped up between the RBI and the government and this whole GDP, revision drama, one has to keep in mind that we are running towards an election. So some of this, always sort of this chatter always picks up when we are close to a general election.
There could be merit in that, but really, I mean, it's a topical point. It doesn't really change the underlying aspect. It is true that growth momentum hasn't been as great as perhaps the government would have been hoping for. But really, who are they going to be deceiving by cooking up numbers? And I'm not saying that that's what has happened, but clearly many different things raise questions. And there still hasn't been a very holistic way of addressing these issues. And I don't think it's necessarily going to go away. I once again come back that it's one thing to revise numbers, and US revises numbers, for example, quite often, and sometimes the complexion can be different, and this is a developed country. So it is not so much data revisions per se, but in this case, the frequency and the magnitude and just completely topsy-turvy outcomes. So what are analysts really meant to, conclude from a lot of these changes?
No, fair enough. Rajeev, before I move to global aspects, which are equally important as the domestic ones, I do want to get a quick word from you on, fiscal policy. We seem like we're struggling again on the fiscal deficit. Again, there are two schools of thought that, let the government bite the bullet and say, okay, 3.3 is not sacrosanct. The economy needs support. We're going to do 3.5. Are you in that camp, or do you think they need to maintain consistency and, sort of reliability?
I think consistency is very important. Don't forget, for twice the government has already revised up the fiscal deficit forecast. Previous year as well, even though they landed up meeting it. But, meeting up a revised up forecast, I mean, I'm not sure how much kudos should actually go necessarily. And again, bear in mind this talk about spending money by government and that is going to revive growth or cushion growth. I'm not sure it's really going anywhere. I think far more is the importance of relevant reforms that need to come through. And bear in mind, while the government has done many meaningful steps which sometimes don't get fully well appreciated, there remains pretty hard-hitting reforms that are still very much on the back burner. And that is where you really need to unlock that growth momentum. So no, I'm not one of those who thinks first sign of pressure just once again resort to the fiscal link. Don't forget, just 2 months ago, everyone was worried about a variety of different dynamics. I think one of the features that perhaps distinguishes India from Indonesia, and I bring up Indonesia simply because they have many similarities, including tectonic election outcome in 2014, and both are going to go into elections into 2019, is Indonesia, I think, has had far better macro management than India. A lot of the external pressures were very similar. The central bank in Indonesia really has distinguished itself this year with very clear, uncompromising guidance in terms of how it's going to react to things, especially with the currency pressures, etc. And I think we need to understand if growth has been pulled down and we are talking about a lower trend growth, just using the fiscal pump or cutting interest rates is not going to change trend growth rate. That just requires, getting down and rolling up the sleeves and doing the hard reforms, period.
Fair enough. Rajeev, moving to the global scenario, a couple of things have changed most recently over the weekend, some sort of a temporary truce between the US and China. What did you read into that?
I think it's essentially kicking the can down the road. So yes, it's a breather. We just have to wait and see whether China is going to deliver the goods in 3 months' time, or by the end of that deadline, once again, we are back to square one. Don't forget, a lot of the steps that China needs to take are not necessarily going to be easy. So I think it's a bit premature to celebrate that all of it is done and dusted and China will come through. I think we still need to wait and watch. The only positive being we've got a bit of a breather. That's always very helpful.
So at best, we can say that the additional drag that was expected on the global economy from these trade tensions, the judgment on that can be pushed back by at least 90 days?
That's right, unless we are surprised by China and it comes through with flying colors altogether. Don't forget, first quarter numbers, activity numbers, production numbers in quite a few countries are actually going to disappoint on the downside, simply because fair amount of production would have been brought forward in anticipation of some of these fears related to tariffs, etc. So I would not be too optimistic in the kind of numbers we see for the first quarter at least.
What's your sense of global growth more broadly? I think the oil price decline has obviously been a huge relief to India and the rupee. But if it's emerging from global growth concerns, then eventually it may come back and bite.
That's right, but you can't have it both ways.
True.
So even for EM, dollar softness, oil prices coming off, liquidity flows are going to be much better, even though quite a few EMs in sync with the developed world are going to moderate in growth. Investment-driven economies like India, for example, have a way to shine, in the sense they're not as export dependent as some of the other Asian neighbors. So getting the domestic side better can clearly distinguish India standing out. Just parroting India as the fastest growing, even though it is slowed down, really doesn't get us anywhere. Given where we are in its per capita GDP, it should be growing at least that much, if not much, much better.
Sure. Rajeev, last question, on the US Federal Reserve stance change or apparent stance change. I think a lot of people are, sort of benchmarking what capital flows into India will look like based on whether the Fed is dovish in 2019 or not. Your thoughts?
This month we certainly see another increase coming through from the FOMC. My sense remains markets have perhaps overestimated the kind of guidance Chairman Powell was actually indicating. So while the FOMC members will clearly now show possibly 2 rate hikes in 2019 rather than the 3 that they had earlier, markets perhaps seem to be positioned for an even better outcome, which at this point seems to be a bit of a stretch to me. Having said that, nevertheless, we are nearing the end of the tightening cycle as far as the US is concerned, and that certainly is already becoming a positive factor as far as India, etc., and other EMs are concerned.
All right, Rajeev, I'll have to leave it there, but thanks so much for taking all of our questions from domestic data to global trends. Thanks so much. Appreciate you speaking to BloomberQuint.
My pleasure. Thank you.
All right, that was Rajeev Malik speaking on a whole host of issues. Thanks so much for watching BloomberQuint.